There are 5 major ways that investors can gain exposure to real estate assets. The first way, which is a buy and hold strategy, is the most straightforward way to invest in property. You buy a property as an investment and rent it out. There are 2 ways that a buy and hold strategy can make money. The first way is that rental incomes are higher than the outgoing cost of owning a property. This is rare in Australia, and most property investors rely on tax breaks to break even from rental income. The second way is capital growth. You hold on to the property while it grows in value due to market values increasing, and you sell it for a profit. This second method is more common in Australia, and so buy and hold strategies out of necessity are a long-term investment. Buying and holding is a tried and true method with consistent growth and lots of government support, but it also is impossible to make a profit in the short term and requires you to manage your cash flow throughout the holding period. The second major strategy is house flipping. Popularised by many reality TV shows, the goal of a house flipper is to buy a cheap, run-down property, promptly renovate it to drastically improve its value and resell it for a profit. House flipping can be an excellent way to make a profit if you know what you're doing, but there's also a lot of effort involved. Renovating a house takes a significant amount of work, so house flipping is less of an investment and more like a second job. It also requires a lot of upfront capital to buy the property and pay for the renovations. But if you're proficient at it, you can make plenty of money in a short amount of time. Real estate investment trusts are a way for investors to indirectly invest in a large number of properties at once. A trust fund collects a large amount of capital and utilises that money to buy a portfolio of real estate assets. Investors receive dividends from the profits that the trust achieves. A real estate investment trust is like investing in an index fund, but you make money when the property market goes up rather than the stock market going up. REITs are great for investors who want to diversify their investment portfolio, but don't like the downsides of directly owning an investment property. REITs also have a much lower barrier to entry. The fourth strategy is property development. At the most basic level, the objective of a property development is to take an existing property and turn it into a better one with a bigger price tag. It's kind of like house flipping, but on a much larger scale. A property developer might buy a lot of vacant land and build 30 townhouses there, or an apartment tower with hundreds of homes. A successful property development project is incredibly lucrative, but it requires a large amount of capital and takes a lot of work to complete. Which leads into the fifth method, joint ventures and property syndication. Rather than doing a real estate development yourself, you can invest your capital into someone else's and make a profit that way. Joint ventures and property syndication allow investors to front up the capital, let someone else do the hard work, and make a return on their investment when the project is completed and sold. Investing in property development projects allows an investor to benefit from the lucrative nature of property development without needing all the technical knowledge or expertise. For more information about investing in real estate, download our info pack.